be there. I have it all drawn out so that way it's a fast, short, simple, easy, sweet video for you to watch. So let's get into that right now. What are we going over? The foreign exchange market. What is the foreign exchange market? Well, that is every other currency valued over the US dollar. In my case here, we have the peso versus the US dollar. So let's go over that. As you can see, we have supply and demand. This is demand of our dollar. This is the demand of our dollar, and this is the supply of the peso or any other currency. So let's say we're supplying to Mexico, and they really love our tables. So we are going to be exporting tables to them. What does that mean? That means the demand of our dollar is going to shift up to the right. And when this happens, the value of our dollar just went up because the pesos are being traded in for dollars, appreciating our currency. So now Mexico, known for making very good food, they're going to sell some tacos internationally. So we are going to import these tacos, right? And when we're importing the tacos, the supply of the US dollar is going down. There's less dollars now because we are trading them in for pesos, and I've already drawn this one here. But as you can see, the value of the currency has gone down, and the currency is depreciated, and the title of this is Weak Dollar Equals Economic Growth. Because if the dollar costs less, people are going to actually end up buying more U.S. goods because it's easier to get them because it costs less. So something to think about. So that's that. So how does interest rates and inflation affect your currency? Well, I also have this drawn out for you. So when interest rates are low and inflation is high, the value of the dollar is low. It's depreciated. And why is this? Because if another country wants to buy into our currency and buy bonds in a low interest rate, they're not going to get many returns on investments and stuff like that. So yeah, they're not going to get return on investment. They're not going to want to buy those bonds. Our dollar is depreciated in value because nothing can really come from it at this point. And the same is true for inflation. If inflation's up, that means there's a ton of US dollars in the market, which means they're not worth as much. And that's simple. Same for if interest rates are up and inflation is down, the value of the dollar is up because if there's not many inflation, there's not many US dollars in the market, which means they're worth more. And if interest rates are high, it means more can be created from that dollar if another country were to buy bonds or anything like that in our market. So explain how the value of your currency affects the aggregate demand, aggregate supply model. Well, what shifts aggregate demand? Net exports. When we export more than we import, aggregate demand is shifting to the right? When it shifts to the right, we're in this inflationary gap. We already know all this. This is simple. And when we import, aggregate demand, or if our net export is negative, that means we're importing more than we're exporting. Aggregate demand is going to shift to the left. We're in a recessionary gap now. Price level goes up in the first scenario. Price level goes down in the second scenario. And that is how it affects the aggregate demand, aggregate supply model. Simple as that. And that's because net exports is shifted by, or not net exports, but aggregate demand, a shifter of that is, for the GDP, is net exports. So now let's talk about capital, financial accounts, and how capital outflow and exports in our country affect everything. So first of all, what is a capital and a current account? So a current account or a trade account is really just whether you're in a surplus of trade or a deficit of trade. What does that mean? I have X and M drawn here. So when you're exporting less than you're importing, you are in a trade deficit because you're importing more than you're exporting. I just got my words to switch them up there for you. But still, when you import more than you export, you're in a deficit because you're taking in from another country. If you export more than you import, you're in a surplus because you're giving your stuff to another country. So what does this have to do with the financial account? What is the financial account? Well, the financial account is all the bonds and stocks you can buy in another country. So this is what gets confusing. So if you are importing more than you are, as I already have drawn here, if you're importing, so if X is less than imports, or exports is less than imports, is your money being outflowed to another country? Are you investing in another country, or is another country investing in you? Well, if you're importing, that means that another country is investing in you because they want you to do better because they want to keep selling to you. Simple as that. So when you're importing more than you're exporting, you have financial account inflow because money is coming into your market. It's coming into your stocks, into your bonds because they want you to succeed. Now, the same is true. And also, that means you're in that deficit, right? So deficit means you're at a greater inflow. So just remember that. So what happens when you're exporting? Well, now you have an outflow in your financial market. So when you're exporting, this money from your exports is coming into you, and you're repurposing that and putting it into whatever country, Mexico's economy, because you want them to do better. You're buying their stocks and bonds, and you're hoping to appreciate the value of their dollar, so that way they can keep buying from us. And that is why the capital account or capital outflow is affected by exports like this. So when you're exporting, there's outflow of your capital financial account, and when you're importing, there is an inflow into your capital and financial account, and that is the foreign exchange market. All right, new jutsu time from Naruto Uzumaki Land. Mangi Kyo Sharingan. Pretty much my eyes would turn red, and I'd be able to predict your movements. Not just that, actually. That's what the Sharingan would do, which is just my eyes if I was an Uchiha. But pretty much I'm torturing you. And in real time, it's like 1 second, but in your mind, because of the genjutsu that I'm putting you in, you'd think you're in there for like years, and I'm torturing you. So, Mangi Ko Sharingan, Fire Style Fireball Jutsu, Ice Dragon, Twin Dragon Style, Ice Blizzard Jutsu. Oh, I forgot. Rat, Dragon, here,